Marko Papic. He is the Clocktower Group's Chief Strategist. Marko, first of all, before we even get around the world, you expect a recession in the U.S. over the next 12 months and see the risk that the U.S. is next with this geopolitical instability. Please explain.
Well, yes, I think a lot of the tailwinds that have really underpinned the extraordinary growth of the last 18 months are dissipating. Nominal wages are coming down. The huge real wage gains that came with CPI going from 10% to 4%, that's gone. And then finally, a lot of the excess savings is finally running out. The forecast that it would run out last year was incorrect mathematically, but it wasn't a silly argument. I mean, it was just early. So with the tailwinds for U.S. consumption going away, with capex intentions coming down due to high interest rates, and with fiscal policy actually being a drag on growth, I think that we will have some form of a shallow recession over the next 12 months.
Now, granted, you have been bearish in a number of different areas with the story yet to emerge. One of those areas is India, since we're starting to go around the world here. You've been wrong on that, as you point out, for about 5 years. India has been a very successful equity market. Why now do you continue to see risk there?
Well, I think with India, it is the best performing market in the last 5 years. But the problem is that the story that has underpinned its rise, which is this idea that it is participating in manufacturing rebalancing away from China, is actually incorrect. There is no evidence other than anecdotal that India has seen any actual increase in industrial capex or industrial FDI. And so I think a lot of the rally in Indian assets has been bid up due to this sort of a geopolitical move away from Chinese assets. And I think that that's basically coming to an end, especially with the politics in India coming to an end in terms of being a positive tailwind.
Marko, it's Morgan. Of course, I'm going to ask you about Europe. We've got the snap election and that dynamic playing out in France right now. It has rattled investors in those markets in France. We're seeing it ripple through Europe as well. Add on to that the fact that you have some central bank decisions coming out of the continent as well this week. I realize maybe it's not European Union, but Bank of England, you've got Norway, a number of others. How do investors prepare themselves for the uncertainty on that continent right now?
Well, first of all, I think that a lot of investors still haven't updated their view of the far right in Europe, which I think we should probably retire that term, because a lot of the populist parties have actually moderated considerably. Giorgia Meloni in Italy is a great example of what has happened. She is the head of the Fratelli d'Italia, which was extremely far right. And they're basically now a center-right party in Italy that have allayed the fears of investors since the snap election in 2021 in that country. So I think that the path for Marine Le Pen is pretty much the same. She's going to have to prove herself and her party over the next 3 years in order to compete for the presidential election in 2027. And so it really behooves her to ensure that the market doesn't rally. Doesn't collapse, that the market doesn't discipline in a very painful way French policymakers. And you've already seen her and her various party members start to moderate. But what I think is really important is that this entire episode teaches us that even in a context of slowing down growth, where bonds should be rallying, politics can emerge as a real strong sell-off signal. And I think that what's happening in France is merely an amuse-bouche, just a little sampler of what's coming in the U.S. potentially later this year with the U.S. election.